January 30th, 2025. A Friday that retail investors will never forget. Silver had been climbing aggressively for weeks. 1 kilogram touched nearly 400,000 rupees. Momentum was unstoppable. Traders were euphoric. Cash! Then in a single day, silver crashed 30%. 30%. The media blamed one person, Kevin Warsh, rumored to be the next Federal Reserve chairman. They said his tight monetary policy spooked markets. They said the dollar strengthened. They said it was inevitable. But here's what they didn't tell you. 4 separate events occurred simultaneously on that exact day. Events so coordinated, so precisely timed, that calling them coincidences defies probability. Major banks closed massive short positions at the exact bottom. Global liquidity providers went offline. Margin requirements spiked without warning. In physical silver markets, the only force that could stabilize prices were closed. This wasn't a crash. This was a controlled demolition. And today, I'm showing you exactly how it was engineered. Let's start with the first impossibility. On January 30th, JP Morgan and several other major banks closed their short positions in silver. And they closed them at the absolute lowest price of the day. Now, for those unfamiliar with short positions, let me explain quickly. Normally, you buy an asset hoping it rises in value profit when prices go up. Short positions are the opposite. You sell first, then buy later. You profit when prices fall. So when JP Morgan closes a short position, they have to buy silver back often in massive quantities. And when you buy massive quantities of anything, basic economics says prices should rise from that demand. But on January 30th, the opposite happened. Despite enormous buyback orders from major banks, silver prices collapsed 30%. How is that possible? Because these banks don't short small amounts. They short billions of dollars worth of contracts. And when multiple institutions simultaneously close positions of that magnitude, the buying pressure should send prices soaring. Unless someone orchestrated the entire sequence to ensure it wouldn't, retail traders had been watching these banks closely. They knew JP Morgan had been caught in short squeezes before situations where they were forced to close positions at losses as prices climbed. So when rumors spread that banks would have to close shorts on the 30th, retail investors positioned themselves to ride the expected price surge. They thought they were outsmarting Wall Street. They were walking into a trap. Now here comes the second impossibility. On the exact same day, the same hours, in fact, the London Metal Exchange, one of the largest commodity trading platforms on Earth, went offline. Just offline. System malfunction. Technical difficulties. At the exact same time, HSBC's trading systems also went down. Now think about what this means. The London Metal Exchange isn't some regional player. It's a global liquidity provider for metals trading. HSBC isn't a small bank. These are institutions that facilitate billions in daily metal transactions. When their systems go offline, normal buy and sell orders can't flow through the market. Price discovery, the mechanism by which markets determine fair value through supply and demand, completely breaks down.
Ow.
There are no strong buyers on the other side of the trade. The order book is thin. Liquidity has vanished. What happens in that scenario? Prices gap down violently. They don't decline gradually. They collapse in sudden brutal drops because there's no counterbalancing demand. And that's exactly what happened on January 30th. Retail. Traders watching their screens saw prices falling so fast they couldn't react. Stop losses triggered in cascades. Panic selling accelerated. The entire time, the largest liquidity providers in the world were mysteriously offline. Coincidence? Let's keep going. Now we get to the mechanism that guaranteed maximum damage. Margin calls. Starting in December 2024, the CME Group and other exchanges had been quietly raising margin requirements for silver futures. No major headlines, no breaking news, just quiet circulars sent to brokers. For those unfamiliar with margin, here's how it works. When you trade futures contracts, you don't pay the full price up front. Put down a fraction, maybe 10 or 20%. Your broker lends you the rest. This is called leverage. But if the market moves against you, or if margin requirements increase, your broker can demand more cash immediately. If you don't deposit additional funds, they forcibly close your position. By late January, margin requirements for silver had been raised aggressively far beyond normal levels. And most retail traders who were long on silver were fully leveraged. They had every available dollar committed to their positions. Then, on January 30th, as silver prices started falling, brokers began calling. Add more money to your account, or we close your positions. But these traders didn't have extra cash. They were all in. So brokers started forcibly liquidating positions, selling their silver futures automatically. One position closed, then another, then hundreds, then thousands, which forced sale, added selling pressure to an already collapsing market. And as prices fell further, more stop losses triggered, more margin calls hit, more positions liquidated. This created a doom loop, a self-reinforcing cycle, where falling prices triggered forced selling, which caused further price declines, which triggered more forced selling. And here's the critical detail. The exchanges knew this would happen. They had raised margins specifically to create this scenario. They built the trap, then sprung it at the exact moment when liquidity was gone and banks were covering shorts. Coordinated? Absolutely. Now for the final piece, the one that ensured prices couldn't recover. January 30th was a Friday. Asian markets were closed. India, closed. China, closed. Most of Asia, closed. Why does this matter? Because Asia is where physical silver demand lives. Jewelry manufacturing, industrial buying, coin and bar purchases. The vast majority of real, tangible silver consumption happens in Asian markets. When silver prices crash globally, physical buyers in Asia typically step in. They see discounted prices and start buying actual metal coins, bars, bullion. This physical buying provides price support that stabilizes markets and enables recovery. But on January 30th, those buyers weren't active. Markets were closed. There was no physical demand to counterbalance the paper selling. Western markets were the only players at Dandiv, and Western markets are dominated by financial institutions trading paper contracts, not physical metal. So you have a situation where selling pressure is massive. Liquidity has disappeared. Forced liquidations are cascading, and the only buyers who could stabilize prices are offline. The market had no floor, and prices fell accordingly. Now, I know what some of you are thinking. This sounds like conspiracy theory. You're connecting dots that don't exist. So let me give you facts. Court-proven, legally documented facts. Between 2008 and 2016, JP Morgan traders manipulated silver, gold, and US Treasury futures prices. Not once, not 10 times, not 100 times, thousands of times. And this wasn't the work of rogue junior traders. This was systematic manipulation led by senior executives at JP Morgan's Global Precious Metals desk. The method? Spoofing? Spoofing means placing fake orders you never intend to execute. You flood the market with massive buy or sell orders 10 to 20 times larger than normal market size. Other traders see these orders and panic. Algorithms react. Stop losses trigger. Prices move in the direction you want. Then you cancel the fake orders. You never actually trade. You just manipulated the price. Here's a concrete example. Suppose JP Morgan wants to crash silver prices. They place enormous sell orders, hundreds of contracts at once. Retail traders see this and think, someone big is dumping. Prices are about to collapse, so they start selling too. Algorithms auto-sell. Stop losses hit, prices fall. Then JP Morgan cancels the sell orders. They never intended to execute them. They just wanted to move the price down so they could buy at cheaper levels. This happened thousands of times. And it wasn't hidden, it was prosecuted. In 2020, JP Morgan paid 7,000 crore rupees to settle charges. To senior executives Michael Novak, the managing director, and Greg Smith, known internally as the boss of spoofing, were convicted and sent to prison. This is documented history, not theory, not speculation. Proven in court, and the exchanges where this manipulation occurred, CME Group, the same exchange that controls global benchmark prices for silver, gold, platinum, and palladium today. The same exchange that raised margin requirements in January 2025. Coincidence? So why silver? Why not gold? Because silver has a structural weakness that makes it easier to manipulate. The paper-to physical ratio in silver is over 400 to 1. That means for every single ounce of real physical silver that exists, over 400 ounces of paper silver are traded through futures, options, swaps, and unallocated ETFs, Most of the time, no physical silver changes hands. It's purely financial contracts bets on price movements. And because the physical market is so small compared to the paper market, you can move prices with relatively little capital. A 1 or 2% push in the futures market shifts global silver prices instantly. Gold doesn't behave this way. Gold has deeper liquidity. Central banks hold massive gold reserves. The paper-to-physical ratio is far better. It's much harder to manipulate. Silver is volatile by design. Shoots up fast and crashes just as fast. That's why I've called it the devil's metal before. And the entities that control these paper markets, the big banks, the exchanges, they have the power to influence liquidity, raise margins, and in extreme cases, even shut down trading temporarily. They've done it before, they'll do it again. So let's put this all together. On January 30th, 4 events happened simultaneously. Major banks closed short positions at the bottom. Liquidity providers went offline, margin requirements spiked to force liquidations, and physical buying markets were closed. For coordinated moves, same day, same market. The media blamed Kevin Warsh and Federal Reserve policy, but that was just the narrative, the story designed to distract you from what actually happened. This was market manipulation at the institutional level. It's not conspiracy, it's documented, prosecuted history repeating itself. If you're trading commodities, especially silver, understand who you're fighting against. These aren't fair markets. They're controlled environments where the biggest players write the rules and profit from your losses. If this video opened your eyes, subscribe and hit notifications. There's a lot more they're hiding. Drop a comment. Were you caught in the silver crash, or did you see it coming? Next video, we're exposing how exchanges and brokers profit from your stop losses. You need to see this. Thanks for watching. And remember, in rigged markets, the house always wins unless you know how the game is played.